Welcome to Talk Tickers. You're tuning in for your concise breakdown of the latest earnings moving the market. Today, we're diving straight into the recent SolarEdge earnings call to really extract the key insights you need.
Absolutely. And this call, well, it reveals a company that seems to be actively executing a pretty significant turnaround. In a dynamic global landscape, too. We saw improvements across several key financial metrics and some strategic moves to strengthen their market position. Let's get into the details.
All right, let's kick things off with a snapshot of their results then. Revenue came in at $219.5 million.
Right. But if you exclude a discontinued operation, their non-GAAP revenue, which gives a clearer picture of the core business, was $212.1 million.
Okay. And a big chunk of that was the U.S., right? $132.1 million.
Exactly. That's 62% of the total non-GAAP revenue. Europe brought in about $47.4 million, so 22%. And then international markets were the rest, $32.6 million, or 16%.
So yeah, strong performance stateside seems to be a key takeaway there.
Absolutely. And adding to that picture, activity-wise, their total shipments reached 1.2 gigawatts. That's actually their highest volume since Q3 2023.
Wow, okay.
And interestingly, this was split pretty evenly, 50-50 between commercial utility on one side and residential on the other.
But the average selling price per watt, the ASP, that dropped?
It did, yeah. Saw a significant dip, falling 17% to 17.3 cents per watt.
17%. Okay.
And this was, mainly driven by lower prices in Europe, apparently, and also a lower optimizer to inverter ratio in the mix they sold.
Okay, so a bit of a balancing act then, higher volumes, but lower prices per unit in some places.
No, sure.
Now, what about batteries?
Right, batteries. They shipped 180 megawatt hours. Most of that went to Europe.
But
the average selling price per kilowatt hour for batteries actually saw a slight increase, hit $267, up from $262 before, mainly due to product mix changes.
But here's a figure that really jumps out, their non-GAAP gross margin. It improved dramatically to 7.8%. That's a huge leap from, negative 39.5% last quarter.
It certainly is. I mean, that's a massive swing, and it definitely signals a potential, turning of the tide in their profitability.
Definitely.
Looking at their expenses, non-GAAP operating expenses were $89.1 million. Now, this looks lower than the $16.8 million in the prior quarter.
Which sounds almost too good to be true.
Well, exactly. It's important to remember that earlier figure was unusually low because of some one-off items. A more comparable figure for that period would have been around $96 million.
Okay, got it.
So while reported OPEX is down sequentially on an adjusted basis, the really big story is that improvement in gross margin you mentioned. And consequently, their non-GAAP operating loss, it decreased substantially. $72.4 million loss, down from $184.1 million.
So losses are shrinking. That's what investors want to see, right?
Precisely. And that trend continued further down. The non-GAAP net loss was $66.1 million. Now, that's actually up slightly from $22.5 million loss prior quarter, but the non-GAAP net loss per share showed a significant positive change. It came in at $1.14 compared to $3.52 loss per share before. So a big improvement on a per share basis.
Okay. So the per share figure is much better. And what about their cash position? How's the balance sheet looking?
From a balance sheet perspective, they seem relatively solid. They've got approximately $794 million in cash and investments. Their net cash, after you take out short-term debt, is $455 million. And if you consider total debt, net cash is about $113 million.
And operationally, did they generate cash?
They did. Operating activities generated $34 million in cash. That led to roughly $20 million in free cash flow for the quarter. That's excluding the discontinued ops and CapEx, of course. But generating positive free cash flow, that's always a key milestone, isn't it? Especially for a company aiming for sustainability.
Definitely good to see that positive free cash flow. And they also managed working capital.
Yeah, they made strides there, too. Accounts receivable decreased to $133 million from $160 million. And their inventory, net of reserves, saw a slight dip to $637 million from $646 million. That actually marks the fourth consecutive quarter they've reduced inventory.
Okay, chipping away at that inventory overhang. So looking ahead, guidance, what are they projecting for next quarter?
The guidance for next quarter anticipates revenue between $265 and $285 million.
So growth continuing there.
Right. And a non-GAAP gross margin between 8% and 12%. Now, this guidance does factor in an estimated 2% negative impact from the new tariffs.
Okay, so they're already baking that in.
Seems like it.
Yeah.
And they expect non-GAAP operating expenses to be in the range of $90 to $95 million. So yeah, continued revenue growth and margin improvement seem to be on the horizon, even with those tariff headwinds starting to bite.
Okay, so zooming out from the raw numbers for a sec, what were the key strategic themes? What did management really emphasize on the call?
They highlighted 4 main priorities. First, strengthening their financial foundation, which we've seen some evidence of. Second, regaining market share. Third, accelerating their innovation pipeline. And fourth, ramping up their U.S.-based manufacturing capabilities. And they indicated they've made progress across, well, all of these fronts.
They certainly underscored the revenue growth we discussed, didn't they? Both quarter over quarter and year over year.
Yep. That combined with the expanding gross margins, reduced OpEx on an adjusted basis, and that positive free cash flow for the second quarter running.
All achieved within what they called a challenging global environment. Sounds like they feel they're executing pretty well despite the external pressures.
And a significant move towards streamlining operations is their divestiture selling off a battery manufacturing facility in Korea and also their tracker business.
Ah.
This is projected to further reduce their operating expenses without, they say, having a major impact on their top-line revenue. So focusing on efficiency seems critical to their turnaround plan.
Makes sense. Now, shifting to their market position, they specifically pointed out being recognized as the #1 inverter supplier for rooftop solar in the U.S. for 2024.
That's a big claim.
It is. And they attribute some of this success to the increasing adoption of the TPO model that's third-party ownership, common in residential solar.
Right, where someone else owns the system on your roof.
Exactly. And that model apparently tends to favor domestically produced inverters and optimizers because of the domestic content incentives available now. So being a U.S. manufacturer is clearly playing to their advantage there.
Exactly. And the demand for their residential battery solutions is also growing. That's being fueled by changes in the Section 48 tax credits, which incentivize storage.
Right, making batteries more attractive financially.
And also the increasing participation in virtual power plant programs, or VPPs. They mentioned over 35% of their sites with batteries are now involved in 28 different VPP programs.
No, 28 programs. For listeners, maybe just quickly explain VPPs again.
Sure. A virtual power plant is essentially a network of distributed energy resources, like these home batteries, that can be aggregated, controlled together to provide power and grid services, almost like a traditional power plant, but spread out. This growing participation really highlights the increasing value people are seeing in, managing distributed energy and helping grid stability.
Interesting. And it seems like that trend towards favoring domestic content is also creating opportunities for them in the C&I sector, commercial and industrial.
It looks like it. They're reporting a, quote, robust pipeline of potential projects in the enterprise segment. And they've even secured some significant deals, including a multi-year partnership with a major global logistics real estate company. They'll be integrating SolarEdge solutions across their property portfolio.
That kind of large-scale agreement definitely speaks to growing adoption in that C&I space. Okay, let's turn our attention to Europe. How are things looking there?
Well, they acknowledge the market there still presents challenges, but there's a note of, let's say, cautious optimism regarding their market share. They're seeing encouraging signs in their point-of-sale data, apparently, and getting positive feedback from channel partners, especially in places like Germany and the Netherlands, about their pricing and recent promotional campaigns.
Okay. Any specific initiatives?
Yeah, they highlighted a battery upgrade campaign in the Netherlands. This coincides with the phasing out of net metering there.
Ah, right. Net metering compensated solar owners for excess energy sent back to the grid. Without it, batteries become much more valuable.
Exactly. So this campaign replaces older inverters with new backup inverters and batteries. They expect this to be a significant driver of growth as homeowners look for ways to, maximize their solar investment now.
Makes sense. What about innovation? Any updates on new products?
On the innovation front, their new Nexus platform remains on track for initial production volumes in Q4 2025, so still a way off, but progressing. They also highlighted that their residential solar controller now complies with Germany's Regulation 14A.
Why is that important?
Well, it's important because it simplifies the whole regulatory process for new solar installations that also include batteries, EV chargers, and heat pumps. It essentially makes it easier to get everything approved and connected, so that could open up quite a significant market opportunity for them in Germany.
Got it. And anything else new?
They've also launched a new EV charging hardware and software solution, this one specifically for businesses. It's integrated into their existing energy optimization software platform for their C&I customers. And the aim is basically to help businesses reduce their EV charging costs. It shows them expanding their ecosystem, offering more comprehensive energy management.
And adding some credibility, they mention recognition from VDE Renewables.
Yeah, that's a reputable independent testing and certification institute. This recognition apparently highlighted their technology's advantages in efficiency, safety, including fire prevention, which is always a key concern with electrical systems.
Definitely.
And also the robustness of their cybersecurity mechanisms, saying they align with international best practices. These kinds of third-party endorsements can be really valuable for building trust.
Sure. Now, back to that U.S. manufacturing ramp-up, what are the specifics there?
Well, their efforts have resulted in creating nearly 2,000 jobs, they said. They've reached a production capacity of 70,000 inverters per quarter, and they also announced the shipment of their first C&I product manufactured with domestic content. So that U.S. footprint is growing and strategically advantageous, especially, as we discussed, in the current tariff environment.
Right. Let's talk more about those tariffs. The new duties on products from China, a huge 145%, and other countries at 10%. That's a major factor for the whole industry, isn't it?
Absolutely huge. Now, SolarEdge anticipates a limited gross margin impact, maybe around 2% in the next quarter. That's mainly because they have existing inventory in the U.S. that wasn't subject to these new tariffs.
Okay, so a bit of a buffer for Q2. But after
that, they're projecting a more substantial hit, maybe 4% to 6% impact on gross margin in the second half of the year. And that's after taking into account potential pricing adjustments they might make.
So still a significant headwind later this year. How are they planning to deal with that?
Their strategy involves actively diversifying their supply chain. They're looking for sources outside the tariff-affected regions. The goal is to reduce that gross margin impact back down to around 2% by the first quarter of 2026, and they hope to potentially offset the entire impact later in 2026.
Ambitious goal.
It is. However, they do anticipate that these tariffs will likely mean their free cash flow for the full year 2025 ends up being approximately break even. So that positive free cash flow might stall for a bit next year.
Okay, break even FCF for 2025. That's important context. What about regional sales performance in the quarter?
Interestingly, their sales in North America actually saw a decrease, 18% compared to the previous quarter.
Oh, why was that?
They primarily attributed it to typical seasonal patterns, Q1 often being slower, and also the fact that channel inventories, the stock held by distributors, have largely returned to normal levels now.
So less restocking demand.
Seems so. But despite the uncertainties around policy and tariffs, they remain optimistic about the underlying fundamentals for solar and storage in North America. They pointed to rising electricity prices and increasing battery attach rates as ongoing supports.
And Europe?
Europe, in contrast, experienced a 6% increase in sales quarter over quarter, and they expect most distribution partners there to reach normalized inventory levels by the end of the next quarter, Q2.
Okay. One last point on finance debt.
Right. They stated their intention is to use their existing cash reserves to fully pay down their outstanding convertible debt, although, they added the usual caveat that they're continually evaluating other options.
And on the supplier side, related to tariffs battery sourcing.
Yes, they emphasize they are actively exploring alternative battery sources outside of China to lessen the tariff impact, while crucially maintaining product quality. They also specifically clarified that a previously utilized NMC battery cell manufacturing facility is not currently part of their plans for future battery cell production. So ruling that option out for now.
Okay, so let's try and put all of this into context for investors. This earnings call really does paint a picture, doesn't it? A company in the midst of a tangible turnaround.
I think so. The improvements we're seeing in those key financial metrics, margin, operating loss, FCF before the tariff impact really hits, plus their strengthening market position, particularly in U.S. residential, and that increasing operational efficiency. They're all pretty significant signals.
And that proactive investment in U.S. manufacturing, it seems strategically very smart right now. Positions them to capitalize on domestic content incentives and navigate this evolving tariff landscape, maybe more effectively than companies still heavily reliant on imports.
Definitely. And their ongoing commitment to innovation, the upcoming Nexus platform, their solutions tailored to meet European regulations like that German 14A.
Yeah.
It underscores a focus on long-term growth and staying competitive.
Yeah. Well, the new tariffs clearly present a challenge, a significant one. The fact they achieved positive free cash flow for 2 consecutive quarters before this and are showing improvement in gross margins. It does suggest a strengthening underlying financial foundation, doesn't it?
It does provide some cushion, yes.
Yeah.
And their success in gaining market share, or at least holding their own and being optimistic in key regions like the U.S. and parts of Europe, across different segments, residential, C&I, that's a positive indicator for future revenue potential.
Right. And their demonstrated ability to adapt pricing and promotions, like we heard about in Europe, it shows a certain proactivity, a flexibility in responding to market dynamics and competition.
Absolutely. So for investors following this company closely, the successful inventory reduction over 4 quarters, the clear emphasis on operational efficiency, like selling off those non-core assets, and the strategic steps they're taking now to diversify their supply chain, specifically to tackle the tariff situation. Those are all crucial developments to monitor going forward. And even with the anticipated tariff impact baked into their guidance, that projection for revenue growth and continued gross margin improvement next quarter still offers a somewhat positive forward outlook.
All right, now for our favorite part. This is not financial advice segment. Time to put on our speculative hats and brainstorm a potentially interesting, maybe even outrageous, but plausible trade idea based on everything we've just unpacked.
Okay, let's think. Given that massive tariff differential we just discussed, how about this? Consider initiating a long position in companies, maybe SolarEdge, maybe others that have already established significant solar manufacturing capacity inside the United States and are actively expanding it.
Okay, long U.S. solar manufacturing.
And this is the key part. Pair this with a short position in companies that are heavily reliant on importing solar components, especially from China, and have limited or maybe no U.S.-based manufacturing footprint.
Right, short the importers facing the big tariffs.
Exactly. The rationale here is pretty straightforward, really. The huge tariff increase on Chinese imports creates an immediate and potentially significant cost disadvantage for those import-dependent companies. Meanwhile, those with domestic production stand to gain a considerable competitive advantage, both on cost and potentially grabbing market share. This trade is essentially a direct play on the expected disruption and sort of realignment within the solar industry, driven purely by these trade policy changes.
Interesting. A pairs trade based directly on the tariff impact and manufacturing location. Plausible, certainly disruptive. And that brings us to the conclusion of this deep dive into the SolarEdge earnings call. We've covered the key financial results, their strategic priorities, and management's perspective on the opportunities and challenges ahead, especially concerning that evolving trade landscape.
And just to reiterate, remember, all the information discussed today is purely for informational purposes. It should absolutely not be considered financial advice. We strongly encourage you, as always, to conduct your own thorough due diligence before making any investment decisions.
Yeah, definitely do your own homework. We hope this detailed breakdown has provided some valuable insights for you. Don't hesitate to delve further into the company's actual filings and announcements, and think about how these developments fit into the broader trends you're seeing in the energy and technology sectors. Thanks for tuning in to Talk Tickers.